It is really difficult to get a read on the housing market right now. Some people say it's crashing, other people say it's flat, some people say it's just fine. The reason it is so confusing is because different markets behave differently, and right now we're seeing big differences in how different regions of the country are behaving. The South is different from the West, which is different from the Midwest, which is different from the East. And to help us understand the housing market and make good investing decisions, we have to look at all of these regional and individual market differences. In order to do that, I took a look at the 295 most active housing markets in the United States to make sense of what is going on and help you adjust your strategy based on your local market. For this study, I looked at 295 markets. All the data comes from Redfin, and I chose 295 because that is the number of markets where I felt there was sufficient data to actually learn something. And it goes back to March of 2023, which is a couple months ago, but is actually the most recent month we have good quality data for. And what we're going to look at are a couple of key indicators. We're going to look at inventory, basically the number of houses for sale at any given time. We're going to look at new listings, which is how many people choose to put their property up for sale. Days on market, which is the average number of days it takes for a property to go under contract. We'll look at sales price, of course, and we'll look at a metric I don't actually talk about all that much called the sale to list ratio, which helps you measure whether or not sellers are getting above their asking price or lower than their asking price. And there are obviously tons of other things we can look at in the housing market, but these 5 indicators to me really paint a good picture of what's going on in the housing market. The first metric I want to look at is inventory. And again, of those 295 markets, it is up year over year in 183 of those markets. And there are some huge numbers here. And that is important because as interest rates rise, the expectation is that inventory goes up because demand leaves the market, and this could be a precursor for price declines or even potentially a housing market crash. And so people are rightfully keeping a very close eye on inventory right now. What I described about a market crashing is happening, but only in a couple of markets. There are actually a few that have gone crazy and actually have doubled, more than doubled over the last year, like the Villages, Florida, Austin, Texas, and Spokane, Washington, just to name a few, also Tampa, Florida. A couple really big, important housing markets have seen the inventory that a lot of people were predicting about in a crash. But I think it's really important not just to look at year-over-year data when we're talking about inventory, because during the pandemic, inventory was so artificially low that comparing 2022 to 2023 is not so useful. And what I think is more useful is comparing 2023 back to 2019. And that gives us a good sense of where things are relative to quote unquote a more normal housing market. When you do that, you see that only 20 markets in the entire country, or out of these 295, are higher than pre-pandemic levels. So that's extremely low on a national basis, right? So there's a couple places, they're mostly in Florida and Texas. You see a lot of them in Idaho and North Carolina. So basically a lot of the places that really boomed, Austin being, the biggest name of all of them, have seen inventory go up above pre-pandemic levels, which to me is a sign that the prices are going to decline. And as we'll talk about, those are markets that have declined. But on the other hand, there is the total opposite going on, which is why at the beginning of this episode, I was saying that both things are true. The market is growing, it is going down, all those things are true. When you look at a market like Muncie, Indiana, inventory is only at 21% of where it was pre-pandemic. So in other terms, that means for every 5 houses that were on sale in Muncie in 2019, there is now just one of them, 20%. It's pretty crazy. And there are a lot of other markets that are similarly small in terms of inventory. Regionally speaking, most of them are in New England, and some of them are also in the Midwest. You're going to see these patterns develop as I talk, is that most of the markets that are pretty stable or not showing signs of declines are Midwest and the Northeast. The ones that are suffering the most are definitely in the West, and the South is sort of a mixed bag. In order to represent and just visualize some of the regional differences that we're seeing here, I actually just picked markets somewhat at random from each of these different regions to plot out what's going on here. So to represent the West Coast, I picked Boise. To the Midwest, I picked Madison, Wisconsin. The South, I picked Orlando, and the North, Rochester, New York. So you can see what's going on with inventory on this chart here. The most dramatic, of course, being Orlando, which spiked, fell, came back, falling again. It's all over the place, and is sort of a good representation for the South as a whole, because some markets are doing really well, some are retreating, and so it's a little bit more hectic and less predictable in the South, I should say. So let's move on and talk about why inventory is the way it is. And the main thing to me is all about new listings. New listings, again, are just basically the number of people who decide to sell a home, and you might have heard sellers basically do not want to sell into this market. In fact, out of the 295 markets I studied, only 16 markets have new listings going up over the last year. So this is basically as close to a national trend as we get. I know I said you can't describe the national market right now, but this one is as close as it gets. 279 out of 295 have new listings going down. There's a lot of reasons. We've talked about the lock-in effect for low mortgage rates. Basically, people, they would have to pay a lot more to even trade to a similar house right now. And so they really don't want to do that. There are these 16 markets where new listings are up, and those are in the South, mostly in Florida, Texas. You see a few in North Carolina as well. And so that, again, is consistent. The South is really seeing some of the less usual markets, and obviously this is an example of that. If you want to see markets where there's absolutely nothing going up for sale, look at New England. In Burlington, Vermont, new listings are down nearly 70%. In Concord, New Hampshire, they're down 66%, same in Portland, Maine. There's even places in California, in Truckee, California, they are down 68%. So this is a primary reason why inventory hasn't spiked as much as you might expect in a rising interest rate environment. Rising interest rates have pulled demand out of the market, but if people aren't selling, there isn't that imbalance between supply and demand that you might expect at this point in the cycle. Speaking of the balance of supply and demand, we're going to move on to days on market, which is one of my favorite metrics because it measures both supply and demand. It is a good measurement of not just how many things are coming on the market, but how long they're sitting on the market. What we've seen is about 250 of the 295 have gone up, which is to be expected. When demand leaves the market, you normally see days on market go up. Boise is the most extreme example of this, as you can see on this chart. A year ago, a property was only sitting on the market for about 13 days, which is insanely low. Like in normal times, it's usually like 30 to 60 days. But it went from 13 days up to 88 days in just 1 year, which is almost a 600% increase in just 1 year. The other top two markets for days on market increases are also in Idaho and Coeur d'Alene and Twin Falls, but there's also other really big cities like Austin, Las Vegas, New Orleans, and a bunch of boom towns in Utah have also seen this going on. And again, what that means is that there is an imbalance or at least a shift in supply and demand. When there is more supply than there is demand in the market, days on market goes up. And so that's what we're seeing in the markets I just mentioned. But there are actually a couple of cities that are seeing days on market go down. In Roanoke, Virginia, it dropped 32 days over the last year. And we're also seeing a lot of places, specifically in North Carolina and in Wisconsin, go down. So that shows that demand remains very strong and is outpacing supply in a lot of North Carolina and Wisconsin right now. As you can see in this chart, I really like this chart, the one I'm showing here on days on market, because I think it's a really good, maybe the best of all the charts here, visualization of how things are going in different regions. If you look at Boise, you could see that days on market, again, up 600%, is absolutely exploded. In Orlando, it was the lowest of any of them, but has gone up almost over 300% over the last year. But the quote-unquote boring markets of Madison, Wisconsin, and Rochester have stayed absolutely steady. They have not moved at all, and that is pretty consistent with how they have behaved over the last year or so. While Boise was the sexy market, it went up and now it's coming back down, whereas a lot of these markets in the Northeast and the Midwest have just been slow and steady, and I think this chart demonstrates that well. What this all means, so far we've looked at inventory, new listings, we've looked at days on market. What does this actually mean for sales price? Of the 295 markets, about 2/3 of them are actually flat or up year over year. That's a lot. And you've probably heard that national housing prices are down 2 or 3%. And that is true, but still, and that really is mostly a testament to how big the cities that have dropped are and how far they have fallen, because more cities, they're probably smaller cities, are actually up year over year. And there are actually 37 markets that still have double-digit year-over-year growth, which for context is very, very unusual. So Macon, Georgia is still up 28% year over year. We see Saginaw, Michigan, Springfield, Ohio are all up double digits. And again, a lot of these are in Midwest, a lot of them in Wisconsin, which makes sense given the low and falling days on market. Again, there are about 95 markets that are down. The worst ones are probably, you could guess, Austin is the worst at minus 14%. We have Sacramento at minus 12, Boise minus 12, Seattle minus 9, Phoenix, LA, and Denver all between 6 and 8%. So a lot of, again, really big markets, high-priced markets, and they've come down a lot, and that's bringing down the national average. If you look at cities that are continuing to go up, again, they are mostly in the Northeast and in the Midwest, as you can see on this chart. Now, this chart's a little bit, let me just explain, like when you look at Rochester here, you see it going up and down, sort of like a wave. That is normal. That is known as seasonality. And what really matters here is looking at the trend. And Rochester's trend is still going up. Same with Orlando and Madison. They are still up on a year-over-year basis, which is how we're measuring things right now. Boise, on the other hand, is really down. I actually, to make this all clear, made another chart that just shows the year-over-year change. And look at that crazy chart with Boise. You can see that it was riding really high, where it was up 40% year-over-year in 2021, which is absolutely unheard of. And now it's come all the way down, is at about negative 14% year-over-year. Meanwhile, all the boring markets have stayed in that 0 to 10% range of year-over-year growth and are still sitting right there. So they have just kept plugging along, and as of now, there is no sign that things are going to change right now. The last metric I want to talk about is known as the sale to list ratio. And again, it just measures how much a property is actually sold for in relationship to what it was listed for. And right now, about 250 of these markets-ish, you are seeing the sale to list ratio under 100%. And that means that people are buying less than what is listed for. And that's important, and we're going to get to that in a second. But I do want to say that there are 49 markets where there are still bidding wars. People are still bidding above asking and are paying more than what properties are listing for. Actually, Rochester, New York is the #1 market here, where there is the sale to list ratio is about 107%. So that basically means that in Rochester, the average property sells for 7% more than it was listed for. If you look at Madison, it's about 103, 104%. So you can see that some markets are still having this kind of bidding war mentality that was going on during the pandemic. For the most part, about 84% of the country, people are buying under asking price. And so you can see this in cities all over the country, actually. In Jamestown, New York, it's about 6% below the asking price. In Key West, Florida, in Miami, they're about 5%. Coeur d'Alene is about 5%. Austin, Texas is about 4% below asking. I talk on the podcast all the time about the idea of buying deep. Whether you're an investor or a home buyer, if you're interested in buying into the real estate market right now, I highly recommend, if you're in a market that might have risk of price declines, which is a lot of them, that you try to buy under asking price, because this helps protect you from further price declines. So using Austin or Coeur d'Alene as an example, they're offering 4, 5, 6% under asking price, and they are getting it. And so if you are considering buying right now, that is my #1 recommendation to you, is to try and be patient and to offer under asking price to protect yourself from any future price declines. And this idea of the sale to list ratio and trying to buy under market value, I think underscores the importance of what we're talking about today and why you need to understand the dynamics in your local market. Because if you're in a buyer's market, basically a market where there is more supply of homes than there are buyers, you can behave really differently. You can offer under asking price. You can be very patient, and you can wait for a great opportunity to come to you. If you're in one of these, 15, 20% of markets that are still in a seller's market, like Rochester or Madison, you probably still need to be fairly aggressive in your offers, but you probably don't have as big of a risk of a future price decline. And so really the tactics that you use as an investor or a home buyer really depend on what is going on in your local market. So I hope that this analysis has been helpful to you. I probably didn't name all of the markets that you're personally interested in investing in or buying in right now. Hopefully the overview of these metrics is helpful to you so that you can go find all this information for yourself. Again, I pulled all this information from Redfin. It is free and you can find it there. Thank you all so much for listening. Please let me know what you think of this video. If you have any other thoughts or videos that you'd like me to make in the future, we always listen and appreciate requests and recommendations from our audience. My name is Dave Meyer for BiggerPockets. I'll see you next time.